Wages versus productivity. They diverge in 1971. Income inequality. It starts widening in 1971. National debt as a percentage of GDP. It begins its climb in 1971. Housing prices compared to median income. The gap opens in 1971. The trade deficit. It appears for the first time in 1971. The cost of college, healthcare, and housing relative to wages all break from their historical trends around 1971. Dozens of economic indicators, all pointing to the same year. Something happened in 1971 that fundamentally altered the American economy. On August 15th of that year, President Richard Nixon made an announcement that changed everything. In 1944, as World War II was ending, representatives from 44 countries met at Bretton Woods, New Hampshire, to design a new global financial system. The agreement? The U.S. dollar would be backed by gold at $35 per ounce. Every other major currency would be pegged to the dollar. Any foreign government could exchange its dollars for gold from the U.S. Treasury. This created a fixed exchange rate system, anchored to a physical commodity. Governments couldn't print unlimited money because they needed gold reserves to back it. The system imposed discipline. It limited how much debt any government could take on, and it provided extraordinary stability. For 27 years, inflation averaged roughly 2% per year. Wages rose with productivity, and the middle class expanded dramatically. By the late 1960s, the system was under severe strain. The U.S. was simultaneously funding the Vietnam War and President Johnson's Great Society programs, guns and butter. This required massive government spending, far exceeding tax revenue. The government ran deficits and printed dollars to cover them. But under Bretton Woods, those dollars were convertible to gold. Foreign governments, particularly France under Charles de Gaulle, noticed the U.S. was printing more dollars than it had gold to back them. France began aggressively exchanging dollars for gold, shipping physical bullion from the Federal Reserve Bank of New York back to Paris. Other countries followed. The U.S. gold reserves, which had peaked at over 20,000 metric tons after World War II, fell below 10,000 tons by 1970. The math was simple. At $35 per ounce, the U.S. couldn't honor its commitment. On Sunday evening, August 15, 1971, President Nixon appeared on national television. Without consulting Congress or the Federal Reserve, he announced that the United States would temporarily suspend the convertibility of dollars to gold. The temporary measure became permanent. The gold window never reopened. The dollar was no longer backed by anything physical. It became fiat currency, money that has value because the government says it does, backed only by trust in the U.S. economy and its military. Overnight, every currency in the world became untethered from gold. Governments could now print as much money as their political systems would tolerate, and that changed everything. With the gold discipline removed, the consequences unfolded over decades. National debt. In 1971, it was $398 billion, about 35% of GDP. Today it exceeds $36 trillion, over 120% of GDP. The government could now borrow without a gold constraint. Wages versus productivity. From 1948 to 1971, worker productivity and median wages rose in lockstep. After 1971, productivity continued rising while take-home wages flattened, though total compensation, including benefits, continued to grow slowly. The largest gains still went to capital owners, not workers. Income inequality, the top 1% income share, bottomed out in the mid-1970s and has risen steadily since. Housing. In 1971, the median home cost about 2.5 times the median annual income. Today it's over 5 times. The money supply expanded, asset prices inflated, wages didn't keep up. To be fair, attributing every post-1971 economic trend to the end of the gold standard is an oversimplification. Globalization, automation, the decline of unions, deregulation, the rise of China, and technological change all contributed to wage stagnation and inequality. The oil shocks of 1973 and 1979 caused massive inflation, independent of monetary policy. And the gold standard had its own problems. It contributed to the severity of the Great Depression by preventing governments from expanding the money supply during a crisis. Economists are divided. Some argue the gold standard was an outdated constraint that needed to end. Others argue that removing it enabled the debt-fueled economy that's now straining under its own weight. The charts don't settle the debate, but they demand one. Since the dollar was decoupled from gold, the Federal Reserve has expanded the money supply dramatically. M2, the broadest common measure of money supply, was about $700 billion in 1971. Today it exceeds $21 trillion. That's a 30-fold increase. A dollar in 1971 has the purchasing power of roughly 13 cents today, a loss of over 87%. This demonstrates the long-term effect of fiat currency without a physical anchor. The government doesn't need to raise taxes to fund spending. It can print money. The cost shows up not in your tax bill, but in the slow erosion of your purchasing power. This erosion represents a form of indirect taxation through currency debasement. If you keep money in a savings account, earning 0.5% while inflation runs at 3 to 4%, your purchasing power decreases every year. Over 30 years, that's a potential loss of roughly half your savings' real value. This helps explain why financial education often emphasizes diversification beyond cash savings. In a fiat currency system, holding only cash can erode wealth over time. The system since 1971 has tended to reward debtors and asset owners. Mortgages become cheaper in real terms as inflation erodes the debt. Asset prices, stocks, real estate, rise with the money supply. Cash holders and wage earners fall behind. Understanding 1971 doesn't change the system, but it explains why your parents could buy a house on one salary and you can't. On a Sunday evening 55 years ago, one president severed the link between the dollar and gold. The temporary measure became permanent. The anchor was gone, and every economic chart you look at, wages, debt, inequality, housing, the value of your money, still shows the scar. Now you know what happened. This is educational content, not financial advice.